Imagine you're just sitting there, right? Watching your screen on the afternoon of July 2nd, 2026.
Yeah, just normal trading day.
Exactly. You looked down at your phone for maybe, I don't know, 2 minutes. And by the time you glance back up at the ticker, the price of gold it's launched vertically.
Like a rocket.
Yeah. Nearly an $80 spike in under 5 minutes. I mean, no gradual climb, just a violent vertical green line.
It's the kind of thing that makes you rub your eyes and check if your feet is broken.
Right. And today we are taking a massive stack of fresh financial newsletters, macroeconomic reports, and market watch data to figure out exactly why this happened. We aren't just looking at the symptom here.
No, we have to look at the disease or, well, the underlying mechanics anyway.
Exactly. We're digging into the underlying causes, from a totally shocking miss in United States job numbers to a really silent buying spree by global central banks.
Which is where the real story is, honestly. The flashiness of a sudden price jump is exciting, sure, but the macro drivers are what you really need to care about.
Absolutely. So let's dive in, because the raw data from that afternoon is just staggering. Around 4:30 p.m., gold exploded from $4,060 an ounce to $4,140.
In 5 minutes.
In 5 minutes. And then it settled the next morning around $4,150. So that's a $90 total move.
Which is huge for gold. And silver was even wilder, right?
Oh, yeah. Silver acted, like silver always does. High beta. Super high volatility. It spiked from $59.50 to $61.50 and was even flirting with $62.
Yeah, silver always amplifies whatever gold is doing.
Right. But the crucial detail across all our sources, the thing that really stood out, is the volume. Buyers actually held the line.
Yeah, they didn't just take profit and run.
Exactly. This wasn't a stop-loss hunt or some algorithmic flash in the pan. Defensive cash flows firmly re-entered the market and just stayed there.
And the speed of that capital rotation is what tells you this was fundamental, not just technical. When you see a $90 permanent repricing basically overnight, you are watching the market instantly digest a major macroeconomic reality check.
Okay, let's unpack this, because I like to think of the market like a tightly coiled spring. You know, everyone was waiting for one specific piece of news to snap that spring.
And that news was the U.S. Nonfarm Payrolls report.
Right, the NFP.
Exactly. The market had priced in a relatively stable labor environment. Economists were projecting a gain of, I think, around 110,000 to 114,000 jobs in June.
That was the expectation, yeah.
But instead, the print came in at 57,000.
57,000. I mean, roughly half the projection.
It was catastrophically lower than expected. And it wasn't just the June miss either.
Right. Our sources point out that previous months were revised downwards as well.
Yeah, so the trend itself was failing. The market was positioned for a specific scenario, a soft landing, or at least a slow, manageable deceleration. The algorithms were coiled tight, waiting for the data to confirm that bias.
And then the data did the exact opposite.
Right. When the NFP missed by a 50% margin, that spring didn't just snap. It completely shattered the whole higher for longer interest rate narrative.
Because it signals the U.S. labor market is visibly, undeniably slowing down.
Exactly. A 57,000 print signals a structural stall in hiring momentum. The market doesn't trade on where the economy is today. It trades on the velocity of where it's heading 6 months from now.
Right. It's always forward-looking.
And the velocity just hit a brick wall. That instantly forces a massive repricing across every other asset class. You look at the probability of the Federal Reserve hiking rates in September, it plummeted from 66% down to 51% before the ink on the jobs report was even dry.
Wow. From 66 down to 51, just instantly.
Instantly.
Which that triggers the domino effect into currencies and bonds, right?
Mm-hmm.
Because the U.S. dollar index, the DXY, it took its biggest hit in 2 months. It dropped 0.5% to 100.55.
Yeah, the dollar sold off hard.
And United States Treasury yields collapsed right alongside it, falling to 4.453%. But hang on, here's where it gets really interesting.
Okay, what do you got?
Well, I have to push back on the pure doom and gloom narrative for a second, because our sources also show the U.S. unemployment rate actually ticked down slightly. It went to 4.2%, which actually beat the 4.3% estimate.
Right, I saw that.
So if the headline unemployment rate is technically lower, why is the market acting like the sky is falling? Why rotate all this capital into precious metals?
Well, what's fascinating here is the hierarchy of the data. You really have to look at how traders weigh these numbers.
Okay, how so?
Yes, the overall unemployment rate ticked down to 4.2%. But unemployment is what we call a lagging indicator. It tells you what happened yesterday.
Oh, I see.
The new job creation number,
Right.
that 57,000 print, that is your leading indicator. The bond market is ruthlessly forward-looking. A fractional drop in the overall unemployment percentage is completely outweighed by the sheer lack of new jobs being created.
So the lack of new growth is the real red flag.
Exactly. So when the bond market sees hiring just freeze up, it immediately front-runs the Federal Reserve. Traders know a slowing economy forces the Fed to rethink those high interest rates.
And as those yield expectations drop, the opportunity cost of holding gold just vanishes.
That's the domino effect right there.
Right, because when treasuries are yielding, over 5%, institutional money is perfectly happy to sit in risk-free bonds.
Why wouldn't they be? You get paid 5% to do nothing.
Exactly. But when yields dive toward 4.4% and look like they are heading even lower, suddenly a non-interest-bearing asset like gold becomes highly attractive.
Especially when it's priced globally in a weakening dollar.
Yeah, a lower DXY basically means gold goes on sale for international buyers. If you're holding euros or yen, your purchasing power just went up.
It's a dual tailwind. You have falling treasury yields removing the penalty for holding gold, and a cheaper dollar sparking a buying frenzy globally.
It's the perfect storm for precious metals.
It really is.
Yeah.
But to fully understand this repricing, we actually have to pull back from domestic U.S. employment and look at the global energy markets.
Ah, right. The oil connection.
Because the jobs data only tells half the story. The sources highlight a massive drop in crude oil prices, settling into the $67 to $72 per barrel range.
Right, and the geopolitical reporting around this oil drop in our sources is just incredibly layered.
It's moving fast.
It really is. The reports note ongoing diplomatic talks between the United States and Iran. Now, there is no definitive breakthrough yet, which, maintains a baseline geopolitical risk premium and keeps some safe haven demand in gold. But the dialogue alone is easing broader market anxieties.
Yeah, just the fact that they're talking cools the temperature down a bit.
Exactly. Add to that, the U.S. and Oman are opening new shipping corridors to reduce reliance on Iranian choke points. Plus, Middle East oil production is broadly recovering.
There's a lot of fresh supply coming online.
Right. And we are even seeing macro-political pressure in the U.S. Donald Trump has publicly called on businesses to pass these lower global crude prices down to consumer gas prices. So the entire complex is just aggressively pushing energy costs down.
And if we connect this to the bigger picture, falling oil prices are essentially the ultimate green light for the Federal Reserve.
How do you mean?
Well, energy is the base layer of all inflation. It dictates manufacturing costs, transport, logistics, literally everything.
Right. If it costs less to ship goods, everything gets cheaper.
Exactly. When crude falls from the mid-80s down to that $67 to $72 channel, it acts as a massive deflationary force across the broader economy.
So the bad jobs report forces the Fed's hand, but the falling oil prices give them the actual cover to cut rates.
Yes. It gives them the justification to execute a policy shift without looking like they're, giving up the fight against inflation.
Because inflation is dropping on its own.
Right. If inflation is organically cooling because the base commodity oil is cheaper, the Fed doesn't need to maintain punitively high interest rates. They can loosen monetary policy. And an environment transitioning from tight money to loose money is the absolute foundation of a long-term gold bull run.
Okay, that makes that 4:30 p.m. spike make a lot more sense. It wasn't just a panic reaction to a bad jobs number. It was the market realizing the macroeconomic stars were perfectly aligning for a Fed pivot.
It was a realization of the new reality.
Yeah. But, while day traders and algorithms are totally obsessing over Fed rate cut probabilities and jobs data, the sources highlight a much bigger, much quieter force that's setting a concrete floor under gold prices.
The silent whales.
The central banks. In May alone, global central banks bought a net 41 tons of gold. 41 tons.
In just 1 month. And that isn't a one-off anomaly either. According to a survey by OMFIF and the World Gold Council, 45% of central banks plan to buy more gold in the next 12 months.
45%. Almost half of them.
Almost half. And 90% of them believe global reserves will continue to rise. Kitco specifically warns investors not to just stare at the Fed. The central banks are the real long-term drivers here.
Right, some reserve managers are even expecting gold to hit $5,000 to $6,000 an ounce because of this.
It's massive.
Like, okay, think of it like this. It's like watching a bunch of day traders fight over pennies in the stock market, while a massive whale is just quietly buying up the entire ocean in the background.
That's a great way to put it. The difference between retail investors and central banks is the time horizon.
Right.
A hedge fund might trade a $90 spike on a Friday and take profits on a Monday. But central banks buy in massive bulk, and they hold for decades. They aren't trading on emotion. They are building long-term defensive fortresses for their sovereign wealth.
And when a central bank buys 40 tons of gold, that metal goes into a vault and is permanently removed from the open market.
Exactly. It shrinks the supply. When you have a massive buyer constantly absorbing global supply, you tighten the market's underlying liquidity.
So every time the price dips, there is a sovereign buyer waiting to scoop it up.
Yes. That is the fundamental difference between a speculative bubble and a long-term bull market. The floor keeps rising because the physical metal is literally disappearing.
Wow. Okay, so we have the weakening U.S. labor market triggering the algorithms, falling oil prices, giving the Fed room to cut rates, and global central banks just quietly hoarding the physical supply.
It's a lot of converging factors.
It really is. So the question for you, listening to this, is how to actually navigate this landscape. Because having mapped out this macro environment, we need to talk about practical takeaways. What do the experts in our sources recommend you actually do with this information?
Well, the first thing is acknowledging that a sustained bull run doesn't mean prices go up in a straight line forever.
Right. Tomorrow isn't guaranteed to be green just because today was.
Exactly. The pressure factors still exist.
Yeah.
The DXY is still hovering between 100.5 and 101. Treasury yields are still around 4.5 to 4.5%. Historically, those are still relatively high levels.
So we shouldn't expect zero friction.
No, expect high volatility in the second half of 2026. The transition from a tight economy to a loose economy is never totally smooth.
Which brings up the most consistent warning across all the analysts in our stack: avoiding fear of missing out. FOMO.
Yeah, FOMO is the portfolio killer.
It really is. I mean, when you see an $80 vertical green candle on July 3rd, human biology just screams at you to jump in so you don't miss the train.
Of course it does. But this raises an important question. How do investors detach emotion from their strategy? Because the experts explicitly warn against blindly chasing after those massive breakouts.
Right. If you already bought high during a previous spike, they suggest holding and not panic selling.
You have to have patience. If you're looking to deploy new capital, you wait for low liquidity market corrections. Do not buy the euphoria.
And the analysts actually give some specific technical benchmarks for this. They say if prices drop below the $4,000 an ounce psychological level, that's when you start looking for oversold conditions for a potential reversal.
Which is a much safer entry point.
Exactly. And they specifically highlight a strategy they call the China method.
Oh, I love the China method.
Right. It's essentially dollar cost averaging, but applied defensively. You buy in parts over cycles, just like China does, rather than dumping all your cash in at once.
It forces discipline on a highly emotional asset. Gold is deeply tied to primal market fears, inflation, geopolitical instability, currency debasement. Instead of trying to time the absolute bottom and betting everything at once, you just accumulate steadily over prolonged market cycles.
Because that's exactly what sovereign buyers do. They don't care if the price spikes $80 on a Tuesday. They buy consistently over months and years, which smooths out the volatility of the spikes and dips.
And by adopting that dollar cost averaging strategy, you accept that the market will have false starts. The dollar might temporarily rally, right? The Fed might delay a rate cut.
Sure, nothing is a straight line.
But if you understand the underlying mechanics we've discussed today, that the long-term tailwinds are firmly established, you just use those temporary pullbacks as opportunities to accumulate.
You let the volatility work for you rather than against you.
Precisely.
So what does this all mean? It means the price explosion we saw on the market ticker on July 3rd wasn't an accident or a glitch. It was the violent collision of a deeply disappointing U.S. jobs report with falling global oil prices, a weakening dollar, and the relentless quiet buying of physical gold by central banks.
The tectonic plates of the macroeconomy are shifting.
They really are.
And, as you process all this, I want to leave you with one final kind of lingering question to ponder on your own.
Let's hear it.
We spent a lot of time discussing sovereign entities absorbing thousands of tons of physical gold. Well, keep in mind, these central banks are the exact same institutions that control and print fiat currency. So, if the architects of the world's paper money are aggressively trading their own creations for physical gold, what exactly do they know about the future of the global financial system that the average person doesn't?
Wow. Yeah, that is the exact question you have to ask when you see whales moving like this. Thank you so much for joining us on this deep dive. We hope unpacking these sources helped you cut through the noise, understand the mechanics behind the headlines, and see the board a little more clearly. Keep learning, stay curious, and we will see you next time.